Hi, here's a quick update on the euro dollar FX rate. This is following the update I made on the 9th of June. Once again, looking at a palette type chart layout. This is a monthly chart, it's a weekly, it's a daily, it's a 8-hour chart, 4 hours, 1 hour, 15 minutes, 5 minutes. So the setup is that in each chart, starting from the second, we are zooming into the last part of the previous chart. So here you can see this part being zoomed into here, and then once again you can see here this whole part being zoomed into here in the daily chart. Okay, so this is the setup. That the idea here is that we try to use the big picture patterns to use to set our profit targets, and we try to use the short-term patterns to set our stops. So you have a high reward and low risk. And that's the idea. I mean, theoretically, at least, it has to be sound. So with that, let's just catch up from where we left off on the 9th of June. What I had said was that we should buy a position, a long position in the euro. There was a big picture bullish view of a move to 1.22, and that is what we were trying to play, but using fairly tight stops. So there were two trades suggested. One was a position somewhere around here, where with a stop below, just below the low that had been made for that day, and that was for a 0.25%, 0.25% of account equity. That was the risk on that trade. That was a short-term trade with lower risk. And there was another trade recommended with the longs entered into at the same level around here. And the stop for that longer, slightly wider stop loss for that trade was around 111.09. That was for 1% of account equity. So what you saw happen was that the short-term, very short-term intraday kind of low that was used, that was stopped out. But the trade with the longer, the wider stop loss remained, and then eventually we saw a move up to a new high above the high of this point, which is 112.85. And this low, which was made on the 14th, the day the Fed announced its decision, was 112.96. So marginally marginally higher. Quite disappointing for people playing for good signs of short-term strength. Didn't really go much beyond the previous high of 112.85. So what happened essentially was that when the new high was made, I'd moved my stop up to this level, 111.83. And then I got stopped out at a small loss because the longs had been put in around these levels. So the update now, what do we do now? So if you look at the long-term picture, I haven't really changed my long-term view that this entire decline from 160.40 to 103.40 here is, I think that at least a phase of that is over, and the risk of a move to that this particular rally, which has started from basically, the early 2017 from 103.40, that particular rally has not really ended, and it's going to take us eventually to 122. But can we have some big down moves in the intervening period? That's the question. And I think we can. And so once again, what I'm trying to do here is, while the big picture view remains, I suspect that what has happened, because of what has happened on Friday, in particular the break below this low, which is around 111.66. That low, if you look at this, this is an 8-hour chart. You can see here a sequence of higher highs and higher lows. Once again, I'm using very simple technical analysis, just the Dow theory based idea of the uptrend being a sequence of higher highs and higher lows. Simplicity is very important. And so if you see this, that there is actually a break in that pattern, and that you can see a little bit if you zoom into the last part here and see it here, or even see it here. It's the same part that's being shown here. So essentially it's that break below the 111.66 levels. Right, that's what has actually caused this pattern to break. So therefore I feel that while this will eventually go above 122, we are now looking for a significant correction to the downside, but not breaking below this low, of course. A significant correction to the downside, and then eventually it will turn up again. Okay, so the target is that this particular break that you've seen to the downside, now we're looking at, not the market should not go above 112.96, and it should eventually come down to targets of 108, 108.20 and 107.05. Those are the targets we would be looking for on the downside. So the idea would be now to try and go short to play for this move. So I'll get into the details of that short trade. So how do I derive these levels, just to give you an idea? So if you look at this move from about 103.40 to 112.96, and if you take the 103.40 to 112.96, this is a bull market retracement here. It's about a 9.2% move. And if you look at it, the 61.8% retracement is at 107.05. The 50% retracement is at 108.18, which I'm rounding off to 20. So that's where those levels come from. These are just approximate targets. We're not going to be rigid about that. The most important thing is the status of the trend. Right now, I think the status of the trend is that this uptrend has been neutralized, and we've started a smaller downtrend, which is essentially going to correct this move and come back down to approximate targets at 108.20, 107.05. And so how do we play this? We got to go short, of course, and we're going to use limit orders to go short, because if you look at what's happening here, this is the night of the Fed decision, the 14th. On the 15-minute charts, you can see this big rally. This happened actually before the Fed decision. This is based on the weak CPI numbers that came out that evening before the Fed. The market shot up, made a new high, marginal new high, and then after the Fed raised rates, and more importantly, I think because of Janet Yellen's very hawkish tone, the market has come down and broken below these key supports. So what we're going to do now is we're going to play for the downside. So the plan is this, so we want to go short. Where do we go short? We're certainly not going to go short at market, because when I look at the short-term pattern here on the 5-minute chart, it looks to me like this corrective rally that began from here has not yet ended. So there's more potential for upside. So we're going to try and sell it. Let's look at the retracement levels. We're going to take the retracement of this decline from 112.96 to 111.32, and if you see that 112.96 to 111.32, we have retracement targets at 112.33, and I'm also going to use the 78.6%, which is 112.60. I think in this particular case it's worth betting that we will see even a move to, we might even see a move to 112.60, because remember the high is 112.96, so even if it goes to 112.60 and then comes down, it hasn't really invalidated our view. So the plan is that on the entirety of the short position, the amount of money you lose should not exceed 1% of account equity. So you got to size your positions accordingly. And we will enter the shorts in two parts. The first, out of the total risk, put on 2/3 of the risk by selling at 112.33. So you sell at 112.33 for 2/3 of the risk. And for 1/3 of the risk, you sell at 112.60. All right, so that's the plan. So, and the stop for the entire position is 112.97, which is just above the 112.96. That's good enough actually, because if you're right about the view, it should not go there. So this is the plan: selling for 2/3 of the risk at 112.32, and 1/3 of the risk at 112.60. Yeah, and stopping out the entire position at 112.96, and we will see if it works out. If we get filled on the shorts and we don't get stopped out, and then the market should eventually decline, and then we'll see if we can actually track this decline all the way down to 108.20, 107.05. If you see, those seem like big levels right now, but if you actually look at this daily chart picture, even if you come down to 107.05, you see where it is roughly. It's actually yeah, around here. So when you look at it in the context of the big picture chart, it's not really that low. Okay, so remember, we were as low as 103.40 in the beginning of the year. So that's the plan, and I hope it works out. As far as the fundamentals are concerned, I think we have a fairly confused picture right now, with the Fed almost ignoring inflation data. They seem to have completely changed, and it's causing a lot of discontent in the market. So I think there's not a lot of fundamental input at this point of time. Essentially, I think the market's initial reaction to Janet Yellen's hawkish tone seems to confirm that the market is willing to go for it, to trust the Fed's view that there will be more rate hikes in this one more rate hike this year. But if you try to extend that argument, actually, if you look at the bond market is not buying that view. You could argue that the stock market is not buying the view either. So I think at this point, this is where you see the importance of technical analysis, because the markets can actually register very significant moves without a very noticeable change in the fundamentals. And that's where technicals really help you, because you can take very, very specific views, and once your views are invalidated by new highs or new lows, you can actually exit the position. It helps you to be very disciplined. So here we would exit the position below above 112.96, because our thesis is that one phase of the rally from 103.40 has ended at 112.96. So if we are right, then how can the market rise above 112.96? So if it does, it means you're wrong, so you get out of your position. All right, then the broader view. Just one more thing on the I didn't add the fundamental picture on the 9th of June. So what drives my fundamental, what drives my big picture bullish view on the euro is essentially, I think that this entire, you see that the eurozone is actually stabilizing a lot. There is an improvement in the growth picture. The ECB is also sort of revising its growth forecasts, inflation forecasts. So there is an improving economic picture in the eurozone. And if you see the after Brexit, the two elections we saw in the Netherlands and in France, they are confirming the move back towards a Eurocentric paradigm. So all the concerns we had about the breakup of the euro, etc., these seem to have subsided for now. But more importantly, I think, is the improving economic picture, which will eventually drive the euro back up to 122. Of course, and you also saw, and I think even in this kind of a environment, if you saw the manner in which the rescue for Banco Popular was orchestrated, that also would sort of increase confidence in the euro system, because they're able to take care of these problems. Of course, the Italian banks, well, don't ask me about Italian banks. You really don't want to think about that. Let's see how that plays out. All right, cheers, bye.